Liquidity. If you've watched any trading videos before, you've likely heard about liquidity, whether it be in a sweep of liquidity, buy side, sell side liquidity. Well, what is this? How can we use it to our advantage? And even if we are already using it, how can we tell we're using it correctly? In this video today, I'm going to answer all of those questions. Welcome back, everybody. As you saw from the title, thumbnail and intro, in today's video, I'm going to be going over liquidity and how we can use it. Just everything you need to know to start implementing it into your trading. As you can see, I'm on a slideshow here, so I'm doing a little bit of a different format, just testing stuff out, see how I like it, see how you like it. I'm hoping this can help draw attention to more specific areas instead of if I've just got a big chart, there's a lot of data being shoved in your face, you could be getting confused. And also everyone does it on a chart. I'm trying to be a little bit different here. So, what is liquidity? Liquidity, or seeking liquidity, as you'll come to terms with, is one of the two main functions of price action on the market, with the other one being fair value. I've got a video about fair value gaps. I'll put that in the banner in the top right so you can click on that and watch it after. It comes in two forms, with those being buy side liquidity, often called BSL, and sell side liquidity, often called SSL. It is in the form of swing highs and swing lows, as well as relative equal highs and relative equal lows. So, what do we use liquidity for? We use liquidity for two main purposes, or at least I do. They are either as a reversal or potential point B. So let's say we swept liquidity, we had these lows down here, price swept it here, we came up, came to this point B, which was this buy side liquidity here. Price then reversed and we shifted to the downside. We also can use it as a very clear and obvious draw on liquidity. So I believe this chart was Bitcoin. I believe this is EU or GU. We came into here. I was looking for longs. We just tapped into that fair value gap, so I would have entered here. And we have these relative equal highs, being these two, as a very clear and obvious area for me to target. And as you can actually see in this black candle right here, we did tap it perfectly before rejecting. This is a swing position, either 1 hour or 4 hour, so that's quite a long time you'd be waiting for it to move higher. But either way, it's a great position with a very clear and obvious area to target. So now, swings. What is a swing? So there is two forms of a swing. It is a swing high and a swing low. And these are also free candle formations, which is similar to a fair value gap. And they do actually serve a similar purpose. So, a swing high is when the high of one candle is higher than the highest point of the candle before it and the candle after it. So as you can see, the high here is higher than this high and this high, so this is a swing high. And for a low, it is when the low of a candle is lower than the candles before it's low and the candle after it's low. So as you can see, we also had one here as well. So why are these areas important? Well, if you've ever took a trade or seen people take a trade, these are very common places for people to put their stop losses. So smart money will seek these. As I said before, it does one of two things. It seeks liquidity and offers fair value. So price will seek the liquidity above these swing highs or swing lows, and then will move away. So the swing high is our BSL or buy side liquidity, and the swing low is our SSL or sell side liquidity. The next form of liquidity we're going to jump into is relative equal highs and relative equal lows. So here you can see this is when the two swing highs, so this swing high and this swing high, are relatively close. This is a bit zoomed in so they don't look too close. However, on a higher time frame, they do look pretty close. You can get them where they're exactly the same. You can get them where they're closer. This is just an example. It's two highs which are pretty similar, which we're looking for price to seek. There'll be a lot of liquidity up here as retail uses this as resistance. So they'll put stops below here because we've came down, price sweeps it, and then we get the real move lower, as you can see here. There are a number of other important liquidity levels, with the main two I use being time-based liquidity and intermediate term highs / lows. Time-based liquidity is based off two parts, so there's going to be two slides to explain the session and the day. First things first is time-based liquidity. Okay, so as you can see, I've had to jump over to the charts. I was just editing the video, and unfortunately, this portion of the video did not record well, so you can't see anything. So I'm going to quickly explain it. So the first part of time-based liquidity, which you did see, was with day. It's also weekly. So This is daily or weekly levels of liquidity. These are important as they're significant draws on liquidity, so that means they're strong. So when price comes down to them, if we do react, which we could expect anyway, obviously with the circumstances aligning of market structure, etc., these could be very powerful areas for price to potentially reverse away from. So I'll show you daily first, and then I'll show you weekly. Obviously, they're the same as any other area of liquidity, where we can either use them as draws or areas to potentially reverse away from. So, for example, as an area to potentially move away from, I'm on NZD USD on the daily, just gone on a random chart, just to quickly show. As you can see, we had this low, so very obvious low. Price swept it once here, we then moved away. We then, on this day, we swept this day's low, which is also below this, and then we displaced to the upside. You could then have used this high as an obvious target, which is up here. You can use this on any pair. I can go through and show you some others. For example, there's quite a lot on DXY here, but there's a good example on the weekly. We have this low, which we haven't gone to yet, which is down here. And if this would be, as you can see on the daily, we are displacing lower. We've displaced through this low. We're very clearly gone lower. This could be a potential area, this weekly low, where price could look to reverse from. So I'll jump onto NZD again, and I'll just look through the charts, just see if anything on the daily points out where I can show it more. So we could use this, for example. We have this high. This high was the highest point we put in before we came below this low. Price came up, we swept it here, and then moved lower. We do have this on higher time frames of swings, but we can also use it for the previous day high. So when I get on my charts, marking out the previous day high and low and the previous week high and low are very important. So if, for example, we pick this high right here, so this green candle, as you can see, so we had the high. This candle, we swept that previous day high and then moved lower. It will probably be clearer if I go down to a 4-hour chart, or maybe even a 1. Not necessarily, however, we had the previous day high, price went up there pretty much instantly, and then we sold off. So if you're trading, this would be Asia, but it is New Zealand dollar, so this would be a pair which would be good to trade through Asia. You could have said, okay, we've came above the previous day high, which is this line here. We've then moved lower, we've created a fair value gap. You could have got in here, again, still in Asian session, and then you could have had a lovely sell to the downside, targeting this low, which is also a daily low. So as you can see, you just can keep going from zone to zone. It's the exact same on the weekly, so these are just more powerful. So the higher you go up on the time frame, the more powerful it is. You could also do the same on the monthly, where you have areas like this high, which we swept and moved lower, or we took this previous month's high right here with this candle, just above this green one, and then we had this huge move to the downside. So yeah, the higher the time frame you go up, the more important it is. Marking out the previous day's high and low is very important. And yeah, that's a key area you want to look for price to take. Even if it isn't a swing high, for example with this wasn't a swing high, but it was the previous day's high, which we swept before moving to the downside. So yeah, that isn't as in detail as the slide. However, I'm just editing a video, so I just quickly wanted to add that in so you're not missing out on any content. So this is the second part of time-based liquidity, and as you can see in these bullet points, we have the timing sessions for each kill zone or each main session people trade. It's always a good idea to pay attention to these areas as they are key points of the liquidity, that being the session's high and low. So as you can see on the chart, this was Asian's low as it was at 9:30 p.m, which is between 6 p.m. and 1 a.m. This is all New York time, by the way, which you should have your chart set to, as it's kind of just the universal time traders use. I trade London, so the main sweep I look for is Asia, as it was a session just before, as you can see, closes at 1 and London opens at 2, although I don't start trading until 3. It's still the most recent session. So here we have an example of what I believe to be UJ, where price swept the Asian low and then we moved away. You could have had a really good buy in this area before moving higher. Essentially, these are just other swing lows and swing highs, but we look for price to react more aggressively for them as they are more key points of liquidity, as there is just more liquidity below the high and low of each session. Okay, so this is the final form of liquidity before I'm going to show you what a sweep actually is. As you've mentioned, we speak about a sweep of liquidity, which is the main way you're going to actually use these areas to your advantage. So intermediate term highs. In this example, as I'm showing you a high instead of a low, for a low, by the way, it would just be mirrored, so it would just be the opposite. So it's when we have a swing high, which is higher than the swing high on the left and the swing high on the right. So we can almost look at this as a swing high of swing highs. So in the same way of a swing high, you want the high to be higher than the previous candle and the next candle. You want this swing high to be higher than the previous swing high and the previous swing high. You could also have used this one, but this is just clearer and it would still make this highly intermediate term high. So that doesn't matter. So as you can see, we displaced away from this. So this also, it's a very obvious high. This is just another way to kind of pick out the obvious highs. So here you can see this was on gold, and we came up into this, I believe, on a 1 hour chart, and gold was displacing higher massively. As you can see from these big candles, we are very, very aggressive, and we know what gold is like. When gold gets going, it gets going. But even this intermediate term high slowed it, and we closed below before we did eventually trade above. However, these can be very good areas to target, or areas if we did have this and a shift lower, could have been a great place to sell from, or I could have easily put my TP up to here and I could have took some more profit. Okay, so now I'm going to jump in the charts. I've kind of been doing this freestyle in this video of what I was going to do, but I've just realized I haven't showed you what an actual sweep is of liquidity, so I'll jump in and show you that now. Okay, so as you can see, I've jumped into the Bitcoin chart, as I believe this is a very, very clear and obvious area to show a sweep of liquidity. So if I just quickly move this, as you can see, we have our swing high. This high is higher than this candle's high and this candle's high. So we then came up to it here. As you can see, price, we opened down here, we made this huge move up. Price came up here, even though we did go above it, there is this rejection, so there is clearly no intention to end up going higher. So we came up here, failed to close. However, if we use, for example, this low, this is also a swing low. It's a very obvious swing low. It's lower than the lows around it, so it's intermediate. What happened when we came here was price closed below it. So this isn't a sweep. We wouldn't be looking, sorry, this candle right here. As you can see, we closed below it. We created a fair value gap for it with this candle. So when you see this, you're thinking, okay, even though we did end up moving higher after sweeping this low, we closed below this, so we're not just going to start looking for prices to move higher, because what did ultimately end up happening, we came back, pulled up, came up into this fair value gap, and then price moved lower, and we're still continuing downwards. So although you want to mark out the swing highs, especially of sessions or days, as again this is daily liquidity, it's all-time highs, so it's a very significant obvious high, or this one being intermediate, as it's quite a bit lower than this one and way lower than this high. These are obvious areas in the market. However, it's very important to look at how we react to these zones. So this closed. So coming into this day, you could say, okay, we closed below an area of liquidity. Price clearly wants to move lower. Otherwise, you wouldn't have. So what could we be seeking? Potentially this fair value gap. Potentially this fair value gap, which we ultimately did go into. Again, as price is either seeking liquidity or fair value. So the fact it displays through this liquidity, we can make the assumption, we're not always going to be right, that we are going to be moving for liquidity. Fair value, sorry, which is offered in these fair value gaps. Then swept liquidity up here. Okay, so price has now swept liquidity. We're now going to likely want to come up into fair value. We did have these two gaps here. We don't know what one it's going to go into. All we can do is look and see how we react. Price came up into this and then moved lower. So I hope that quick explanation, I've kind of gone through everything quickly because there is quite a lot to unpack. However, I've gone over it in I've not gone into too much detail, and I've just gave a very basic explanation of each, so you can start implementing these, because the truth is, they're not that complicated. They can be very easily overcomplicated, but the truth is, swing highs, swing lows, we have time is very important, so whether that's the previous day, the previous week, previous month even, which I didn't explain, but it's the exact same. Sessions, if we close below it, we can expect or predict we're going to move lower. If we don't, we can. Obviously, there is times where, for example, we swept this high and then price moved higher. You're never going to be right. I don't know if we swept this high or swept this low first. We could have swept this, swept that, and then you would be expecting that. However, that's just how it works. We swept this low here and then price moved higher. That's what we expect. But sometimes we might sweep a low. I'll try to find an example. As you can see, it doesn't happen very often. But here, for example, we had this high, not intermediate, of course, but we swept it and then price did go higher the next day. So you're never 100% going to be right. However, this was the intermediate high. We had this swing high and this swing high. Price did sweep it and move lower. So this stuff is pretty accurate, especially on a higher time frame. Obviously, the higher the time frame, the stronger, which is why I spoke to you about daily and weekly, as these are very key and strong areas of liquidity. There is a lot of stops below them, especially banks. Banks, you're not going to see a bank on the 5-minute time frame. They're going to be on the dailies, the 4 hours, weeklies, monthlies. So this is where the big liquidity resides for the market to take orders and take them lower. So yeah, I hope that made sense. I went on a bit of a rant at the end there. It's a kind of different style of video. I hope you enjoyed. I hope there's some insight you could get, and I'll see you next time.